There are 4 main investment types or asset classes that you can choose from, each with distinct characteristics, risks, and benefits. The asset classes are cash, fixed interest, property, and shares. Cash and fixed interest are defensive assets. They have lower returns but low volatility and risk. Property and shares are growth assets. They have higher returns but higher volatility and risk. Therefore, defensive assets are more suitable for short-term investments, whereas growth assets require long-term investment timeframes to smooth out volatility and deliver a higher return. Depending on your individual circumstances and investment goals, having exposure across all 4 main asset classes is preferable because each asset class behaves on different cycles. We call this diversification. There are different ways to access these asset classes. Some of these are mutual funds, ETFs, direct property, and direct shares or equities. When you invest in a mutual fund, your money is pooled together with other investors. A professional fund manager then buys and sells assets, such as shares or bonds, on your behalf, and on behalf of all other investors in the fund. An ETF is a fund that you can buy or sell on the stock exchange. Unlike mutual funds, most ETFs are passive investments that don't try to outperform the market. The value of the ETF goes up or down with the index or asset that they're tracking. Direct property investment is often seen as being less risky than other forms of investment. While it may seem more straightforward, there are pitfalls to be aware of that your advisor can explain in detail. Finally, with direct shares, some of the benefits are their low startup costs with the potential for high returns. On the other hand, they have a limited ability to diversify with a small capital amount, require brokerage fees to transact, and are subject to market forces which bring higher risk.